Okay. All right. So welcome everybody. My name is Mike Baragel. I am a general business counselor with the SBTDC here in Charlotte, North Carolina. And I'm excited for you all to join us today. Thank you for spending some time with us here on Wednesday afternoon on a gorgeous day here in the Carolinas. We've got an excellent presentation coming up from folks at the organization E-Tax Breaks to talk about the topic of tax incentives as non-dilutive capital. And I know with so many new businesses starting and a lot of businesses that have kind of navigated some difficult circumstances over the last year and a half, of course, I think this is a great topic, one that I've learned a lot about just from talking with these folks. And I think there's going to be some really useful information and things that you can apply to your business pretty quickly. So thank you for joining. Just really quickly, I know that this notice went out about this webinar to SBTDC clients, and so it's possible that some of you are pretty familiar with our services. But if you're not, or you haven't been in touch with us in a while, we are basically a small business advisory organization where we are statewide throughout North Carolina. I'm part of the Charlotte office, and we can provide no-cost business counseling, trainings and seminars such as this one, and lots of other topics specifically related for small businesses. And we have access to a whole bunch of resources around financial planning, market research, industry insights, lots of things that we can help you connect you with based on whatever it is that you might need. And so if you need any assistance in any way, feel free to reach out to your counselor if you know who that person is already. And if you don't have one, you can reach out to the SBTDC just by going to our website and clicking on register as a client or register for counseling. I'm just going to go ahead and when I have a chance here, I'll drop in our website, but it's just sbtdc.org. So with that said, I'm going to hang back here and pass it over to the folks at E-Tax Breaks. I believe my buddy Steve Lewis here is going to kick it off for them and introduce the team and the topic here today. So I hope you enjoy.
Mike, thank you very much. And we are really excited to be with all of you today. I'm excited to have two executives from our team on the call today. Shannon will be speaking, and Lindsay will be following up with the questions that are asked. And without further ado, I'm going to turn it over to Shannon to handle the conversation. After this conversation, I'm also in Charlotte with Mike, and if you have questions, my contact information will be available. I look forward to following up with you. Shannon, to you.
Thank you, Steve. Good afternoon, everybody. Appreciate your time being here today. Hopefully we can keep this presentation under 40 minutes, get you guys back to your day. And again, we appreciate your attendance. A little bit about me. My name is Shannon Scott. I'm the co-founder and chief growth officer at E-Tax Breaks. I've been in this tax credit business for over 20 plus years now. I'm also an entrepreneur, started and sold over 15 companies in the last 20 years. Look forward to presenting some alternative financing and sources of capital solutions for you guys today. Maybe covering a little bit about traditional capital raises and things that I've experienced, and obviously a lot of you being in the startup world are going to experience as you go through this growth process. We all know startups are an amazing, beautiful thing. They're scary things as well, and capital is king, especially in this time, in this environment today. Covering a couple things here, and we're going to get into the tax credits and how they can help not only raise capital for your organization, but sustain profits in the non-dilutive side of things. But let's talk a little bit about non-dilutive and dilutive funding. Obviously, non-dilutive funding are things that don't require you to give up equity or stock in your company. For example, loans and grants and tax credits. And we'll get a little bit more in detail here in a second here. And dilutive, obviously, equity financing. These are typically situations where you're going to have to give away equity, whether it's on the front end or the back end or stock in your company, depending on the type of corporation that you set up for yourself. Could include, giving away future profits as well. Our conversation today has tried to give you tips and tools on how to take advantage of the non-dilutive side of the capital raise. So let's talk a little bit about dilutive funding. Most of you guys have already been through this. If you've been through any of these mentoring programs, you've heard of these terms. The two main sources of dilutive funding that you see out here for startups are venture capital and angel investment. little bit different in the two. Venture capitalists traditionally invest larger sums of money than an angel investor would. Venture capitalists are also investing money as part of a larger fund or a company, where angel investors are typically, someone like myself is typically investing our own money, our own capital, and not going out to larger funds. Venture capitalists typically want more control over the business. What I mean by that is not necessarily stock. In a lot of cases, they want to be on the board, or they want to have more to day-to-day insight into how the business is operating and how the business is running. Where an angel investor typically, even though they do ask for more stock because it is coming out of their pocket, a lot of times you see them as more of a private partner. Obviously, they're going to be attending board meetings and things like that, but we tend to see venture capitalists, they have their finger on the pulse of the business a little bit more. And a lot of times angel investors, depending on the type of capital and how much capital you're raising, they're going to want to take a majority position, at least until some of that capital is paid back. Sometimes they try to put things in a convertible note, and they can dilute their stock based on payments back. So two major categories of how to kind of raise capital from a dilutive funding perspective. Obviously, non-dilutive funding, great things, pros and cons. Retain control of your own enterprise. I think all of us want to do that, especially from a startup perspective. Even though sometimes in the venture world, it is nice to have someone that's a mentor that you can rely on, who's been there, done that, not only sold businesses, but also probably, hopefully been in a vertical industry such as yourself. You don't have to cater to the whims of venture capitalists and angel investors, which means you don't have to report to someone. You do maintain control of your own business and operate and run the business the way that you see fit. And you can sell shares later for a significantly higher valuation simply because you own more shares. Pretty simple. As your company continues to grow, there are other opportunities when your stock price may increase because your business is worth more, that you might want to go out and look at a venture capital or angel capital situation in a Series A raise, again, once you have a little bit higher valuation. So sources of non-dilutable funding. Traditional sources are crowdfunding. I think most of you have probably heard of programs like Kickstarter or GoFundMe or Indiegogo. Great sources of funding for startups. Look, with any kind of funding, you run a risk and there's reward. The reward of non-dilutive funding in a crowdfunding perspective is you're not going to give up stock. The risk is you are going to give your business's idea to companies out there who may be looking to crowdfund, but they also have resources that you may not have access to build on your ideas or to take those ideas. Some crowdfunding sources do ask for NDAs. A lot of them do not. So you do run the risk there. Obviously, there's loans from friends and family. I mean, I think that's a great source of capital for any startup, but you do run the risk of borrowing money from family and friends. And I think everybody, that doesn't need much explanation of what that can do to strain a relationship down the road if things do not work out. Licensing, which would be royalties, similar to royalties, it would be like a private label. You guys are probably familiar with royalties. If you ever watch Shark Tank, you notice one of the most popular investors on Shark Tank, Mr. Wonderful, he likes to do a lot of licensing and royalty deals. Number one, look, you get to keep the stock, so that's a great thing when you're paying royalties out in consideration of financing. But you are going to reduce your profits, your profit margins on your products or services when you're paying royalties, and it can hurt cash flow down the road. So there's a risk there as well. And the alternative source, and the source that we probably don't cover a lot, and you typically in your venture capital world or any kind of capital raise world, is tax credits. There are sources of government money out there for startups, for existing businesses, based on people that you hire, locations of where your company is in the country. And these are things that are not considered much because most of the time tax credits are considered on the back end. It's only available when your company is profitable. Times have changed and things have changed, and some laws have changed recently that allow you to take advantage of startup capital as well through these programs. So let's talk about that. Let's get into the tax credit conversation real quick. So what is a tax credit? A lot of times people will understand a tax credit as a tax deduction. They're two completely different things. So what a tax credit is, it's a dollar for dollar reduction or a refund on, again, any amount of tax that you owe to the government, where a deduction is a percentage of what you can save off of paying taxes. You can deduct mileage, you can deduct office expenses, you can deduct furniture, a certain percentage of that. A tax credit is a dollar for dollar or full reduction. on your tax liabilities. And again, they can come as a payment down the road, they can come as a refund right now, and they can reduce the amount that you pay in income taxes or payroll taxes as you continue to grow your business. They're more favorable than tax deductions, obviously, because they do reduce that amount where you're going to see a deduction reduce in many cases 60%. A tax credit is going to reduce your liability by 100%. So there's a couple basic types of tax credits, as we discussed earlier: non-refundable, refundable, and partially refundable. And we'll get into details of what those are. Simply put, non-refundable means you're going to get a credit on future taxes that you're going to have to pay. An example is an income tax situation. As your company becomes profitable and you do owe taxes to the IRS, there are ways through tax credit programs to reduce the amount you owe, which is 100% cash back into your business. There are refundable credits where you can go back up to a year, sometimes even 3 years, maybe even per quarter, and actually get a refund from the IRS on credits that you have failed to file because you simply overlooked them, or your financial partners or CPAs overlooked them. A lot of times people just go ahead and assume that their CPAs are doing these credits for them. 99% of the time, that's not the case. It is not the fault of a CPA or a financial advisor or a CFO. Tax credits are not something you learn in tax school. It is a very small portion of the tax law. CPAs are not trained to process these credits. They're very particular, they're very geographic, and they're very small in nature typically compared to other tax deductions and everything that a CPA typically has to handle on a day-to-day basis. That's why companies like us exist. And then there's partially refundable, which means, yes, you can take an actual cash refund on some of them, and then some of the credits that are actually included in the same category, you probably need to hold off, carry forward, and take them off future taxes. So let's talk a little bit about us so you guys understand we're not just here today just making this stuff up. We've been doing this for about 20 years, helping small businesses, well, all the way from small businesses to Fortune 500 companies, supported about 350 businesses currently. And we found about 1.5 billion, excuse me, I'm trying to undercut myself here, $1.5 billion in tax credits for small businesses and mid-sized businesses. And this just in the last couple of years. Significant amount of money and financial gain for businesses out there if you understand how to use the program, take advantage of the program, and you execute it. So the 5 main categories of credits I want to talk about today, and I'm really going to focus on one in particular, especially for startups and especially for entrepreneurs. And it's this brand new credit that's come along the last 2 years called the COVID-19 Employee Retention Credit. There is a credit for organizations that continue to keep their employees or startups during the COVID pandemic. It is a payroll tax credit. It is refundable. You're going to get the money you pay back in tax and payroll tax credits. And we're going to get into that here in just a little bit in more specific detail. There are credits for disasters. If your business was affected by any disaster, if you're in North Carolina and for whatever reason, you may have had an office or a location or a client base that was located on the coast during the hurricanes, your business was affected, whether it was a revenue drop, whether it was you couldn't have employees come into work because they had damage to property, whether maybe you had supply chain issues, you're a restaurant, convenience store, retail store, couldn't get supplies, obviously, because of the damage. Supply chains being damaged during COVID also can qualify you. There's a research and development tax credits. A lot of startups these days are focusing on software, medical development, medical device development. If you pay individuals in your organization who do research or development, that can be software development, product development, there are credits that are available, cash credits. These are refundable to your business. And the last 2 are empowerment zone credits and work opportunity tax credits. Empowerment zone credits are very simple. You live and work in a certain area, there's tax credits available. And we'll get into detail a little bit more about that. And then work opportunity tax credits. This is a credit as your business continues to grow, you're going to want to take advantage of. It is based on demographics of individuals that you hire. We'll get into the details of who those are, but we strongly encourage, and we'll tell you a little bit about how to kind of create a hiring program around incentives that not only help these individuals who have a higher barrier into employment get jobs, but also you can take advantage of the tax incentives as well. So let's get into the COVID payroll tax credit, because again, this is kind of the credit of the hour. And as you see, and as you continue to work these tax credit programs over the year, you'll understand Congress passes these kinds of credits all the time. It can be up to hundreds a year. Right now, actively in the United States, there's over 3,000 different types of incentive programs, all the way from a federal, state, and local that you can take advantage of. So how much is the credit and how do you process this credit in particular, especially if you're a startup or if you're a small business with employees? So the credit is worth up to $5,000. Again, this is refundable for any employee that you had in 2020 that you kept on payroll after the pandemic hit. According to the IRS, that is after March of 2020. So anybody that was on your payroll that you continued to pay federal payroll taxes on, or even benefits, maybe you furloughed them and just paid them benefits while they were furloughed, those benefits count as well. $5,000 per employee cash refund. If you continued to pay them in 2021, doesn't have to be the same individual. It can be different individuals. There's a $7,000 per quarter tax credit for each employee that was retained on payroll. So there's a maximum credit here for your business of $33,000 per employee for retaining them after COVID hit. There's also an additional credit for if you paid any employees that were home sick with COVID. This only applies to employers that are under 500 employees. I'm assuming based on the audience we have today, most of those people are going to qualify on the phone call today. But if you have under 500 employees and you paid anyone that was sick at home with COVID, or if they were taking care of anybody that was sick at home with COVID, there's an additional, on top of the monies we just described above, a $511 per day tax credit. And that's for up to 10 days. So you're talking about another $5,000 potential credit on top of that $33,000 that's available. And last but not least, there's an additional credit that's possibly worth up to about $2,400 more dollars on top of that $40,000 we basically already described. And that's an family medical leave payroll tax credit. Essentially, if you had someone working from home long-term who were taking care of a sick individual, or if they had to stay at home because of mandates of school shutdowns and they had to homeschool, there's an additional credit for people that you paid that had to work from home because of COVID. These credits are fully refundable for the year 2020 and 2021. We have 3 years to capture the credits. So you have the ability, and we don't encourage you to wait 3 years to do it. You can always go back because you're going to have to amend tax returns if you do that. The time to take advantage of it is now before the end of this year, so you're not having to amend an income tax return. And the IRS right now is, like IRS does, they're a little bit behind because of the amount of people that are trying to file for these credits. Typically, when they came out, they said it was about a 6-week return period. Right now, we're seeing anywhere between 12 and 15 weeks to get this money back. And as we get into tax season, that number is probably going to increase as far as the amount of time it takes to recover. So if you're interested in looking at these types of credits, we encourage you highly to file before the end of the year. So how do you qualify? What kind of businesses qualify? Essentially 99% of all businesses, especially small businesses, are going to qualify, but here's a couple of categories that we're going to look at. If your business decreased any kind of revenue in 20 or 21 as compared to 2019, now if you're a startup and you only started in 2020 or 2021, this does not apply to you because you're considered under the startup clause, which means you don't have to show revenue numbers. And guys, this is not all or none. Only one of these things can qualify you. You don't have to have all of them. If you had any kind of operations that were partially or fully suspended by government order, in North Carolina, I know there was a point of time where, especially in some of these larger cities and metropolises, they were shut down from, if you're not considered an essential business, people need to work from home. Maybe you had clients that you could not go see if you typically go see clients in person. Maybe you had employees that had to work from home because your office building was shut down. That's considered suspended or operations. Now you do not have to close fully. You just have to change the way you do regular business. If before March of 2020, you had people showing up in the office every day, and after March 2020, they weren't showing up in the office every day, that's considered partial suspension. If you had to put any mask mandates on your employees, if you're a restaurant and you had to, or a food service business and you had to do extra sanitation practices, maybe even in your office, Maybe you had to purchase sanitation equipment. That considers a partial interruption. Anything that your business had to change will qualify you if it was pre-2019. Again, if you're a startup and you started in the last 2 years, you don't have to meet those qualifications. You're automatically qualified based on the fact that you're a startup. I'm going to give you a couple case studies here because I want you to understand the types of significant money we're talking about here. And again, when we're talking about capital, we're talking about raising capital and all the risk and reward that we talked about earlier, this is free money. This is money that the government's handing out. This is not a PPP loan. You do not have to pay this money back. These are programs incentivized to keep economic development going and businesses open, because as the government and businesses shut down, we all understand that the revenue the government collects decreases, which causes a cash flow issue for the government. So this is why these incentive programs exist. Here's an entertainment video of 35 employees. That's probably on the higher end of the spectrum of what we're seeing on the phone call today, as far as your business is concerned. But that's $315,000 in cash refund that they received only for 2 quarters. This particular business is actually going to qualify for 4 quarters. So by the time everything's said and done at the end of this year, they're going to receive over $700,000 cash influx to the business. Doctor's office, $216,000. This was qualified for quarter 1, 2, and 3, and 4. So basically it would have been the last quarter of 2020 and all the quarters of this year they're going to qualify for. $216,000 refundable cash credit. You may be looking or thinking to yourself, how in the world can a doctor's office qualify? They're considered an essential business. You guys you would not believe what medical practices, dentist practices, and doctors' offices had to go through in the last 2 years just from a sanitation perspective. They could not allow people in their lobbies the way they used to. They had to have 6-foot distancing. A lot of times they had to take and remove elective procedures. All of those things qualified them. Kind of last but not least, a restaurant. Again, you may not have to be a restaurant. Maybe you're someone who services a restaurant. Maybe you're developing a point of sale system for restaurants. As they suffer, you suffer, revenue goes down. $190,000 for this particular restaurant. They only had 10 full-time employees in 2019. You can see that they grew, but you can see the substantial amount of money that they received from this program. So let's get into disaster credits a little bit now that we've covered COVID credits. I want to reiterate, it is a payroll tax credit. If you pay payroll taxes and you have paid payroll taxes over the last 2 years, you do qualify for this program. And you can file for this credit and receive a cash refund. Disaster credits. We touched a little bit on disaster credits. These are credits that go back 3 years for any disasters from 2018 to 2020. We've already had a couple of hurricanes in 2021. I know a lot of you weren't affected by those, but let's go through them anyway. You may not be personally affected. You may know other businesses that were affected, or again, you have supply chain issues or clients or customers that were affected by this. This retention credit is very similar to what I just described in the COVID credit, except it's not a payroll tax credit. This is an income tax credit. So this is reduced off the amount of taxes that you owe the government at the end of the year when you're paying your business taxes. Everybody pays business taxes. They even pay alternative minimum tax. So you're going to pay a tax regardless. These kinds of tax credits are the only tax credits that can offset that alternative minimum tax down to 0. So you can literally get to a 0 tax base in a federal perspective. Now, it doesn't just have to be hurricanes. I want to clarify here too. If your business was affected by floods, fires, we know that California has the last 3 years, a lot of businesses have sustained substantial damage because of these wildfires. Tornadoes, if you're in the South, everybody knows what a tornado is and everybody's experienced a tornado one time or another. If your business has been through any of these kind of disasters, you could qualify. And most people, again, they come to us and they say, hey, look, my roof wasn't blown off. I didn't get substantial, damage to my business. We didn't have to shut down. I probably don't qualify. My encouragement to you is, whether you think you qualify for any of these programs, reach out to one of us, because most of the time you do, you don't realize you do. It doesn't cost you anything. Again, it's free money. It takes a 5-minute phone call, and we encourage you to do that. Billions of dollars, literally, I think $155 billion was left on the table last year in incentive programs that businesses did not take advantage of. That money went right back to the government's pocket. I wish they would have paid some of their debt down, but they didn't, but it went right in the government's pocket. To give you a little case study here, small business, 5 locations. They only had about 3 employees per location, $74,000 income tax credit. R&D credit, we touched on that earlier in just the brief description. Let's just get into this. I don't want to spend a lot of time on this credit. This is a credit that we really need to kind of get in on one case-by-case basis with anybody that may qualify for these programs. Just really quickly, it's a federal government program. It is a permanent program. It does not have to be renewed. A lot of times tax credits renew anywhere between 4 or 5 years. Sometimes it's annually. These do not have to be renewed. It is a dollar-for-dollar reduction in your tax liability for domestic expenses, such as paying someone to develop software who's on your payroll, paying someone who's doing medical device research. It could be a chef who's trying to improve on a recipe. Maybe it's someone working on improving processes in your business to make you have a expedited release date or an expedited product release date. So processes, techniques, formulas, software, those are all included in R&D credits. R&D credits can be in the version of an income tax credit or a payroll tax credit. They can be refundable depending on a couple different things, the size of your business, how long you've been in business. These are all things we can kind of help you lead through the path. It originally only applied, as I stated, to a few technical companies when it was first launched. The United States was having a kind of a technical software development IT war with some companies or some countries overseas like China. We want to encourage companies to stay in the United States and develop products and services and software. So the IRS, along with the Department of Labor and Congress, came up with this credit to encourage businesses to stay in the United States and continue to develop here instead of offshoring a lot of things. Can you receive R&D credits for employees that you, or I should say contractors that you pay, they're not W-2? Absolutely. They need to be US-based contractors. But you can receive a credit for that as well. So what industries qualify? This is just a few industries that do qualify. We have automobile, aerospace, breweries. Breweries are constantly doing research and development, construction, dental, engineering, fabrication, life sciences, hemp, marijuana. A lot of states have, even though federal government does not recognize the cannabis space as a legitimate business, even though they collect income taxes on them, there are states that have R&D programs for dispensaries, for businesses that are in the marijuana space and the cannabis space. Software development, that's self-explanatory. You're developing software, you have a startup that's doing that, you qualify for this program. So a lot of businesses, a lot of industries qualify. Here's some of the states that also offer these programs. Again, there's a federal program and a state program. A lot of companies can double up on these programs because you do have state income taxes and you have federal income taxes. These are states that you can reduce both your federal and state income taxes. We can provide this presentation to you as well. And states like Alabama, they're in the process, and Tennessee, North Carolina is not on that state right now as far as the state R&D credit is concerned, but there are bills and there are programs in place that are being encouraged to pass these things especially in these southern states right now. I did read an article where the southern states are one of the highest growing, especially North Carolina, Alabama, and Georgia right now from a startup perspective. I think over the last year has had a 37% increase in startups. So I think you're going to see those bills passed, within the next year or so, at least an iteration of these R&D credit bills. So talk about a little bit the software industry. If you do have a software platform, if you're developing a platform and you're enhancing a platform that you may currently use, APIs, building custom APIs will qualify you. Cloud development will qualify you. Implementations for any kind of data science or artificial intelligence or machine learning. These are all things that qualify you for these credits. Going to talk about empowerment zone tax credits now. I'm just going to briefly touch on them. Most of your businesses are probably not going to qualify for these credits, but as you continue to expand your business and you're developing offices or warehousing or products in areas of the country that have seen an economic downturn, there are tax credits available. Most major cities they have probably 10 to 15 square blocks that have these empowerment zones, is what they call them. Basically all of downtown San Antonio, There are some credits in Raleigh. There's some credits in Jacksonville, Florida, Atlanta, Georgia. Essentially, what they're trying to do is encourage businesses to either open offices, continue to stay in these locations. And how this works is if you have an employee that lives and works in these considered empowerment zones, there's a $3,000 credit per employee that's available to your organization for keeping your business in these areas. So as you're continuing to grow your organization, you're looking for your next office space, sometimes in strategic planning and cash flow planning. Sometimes it's good to look in areas like this because you'll find it's not necessarily areas you think they are. It's industrial areas, manufacturing areas. But open a business there, start hiring people from those areas, and you'll see an increase in cash flow just based off these programs. Work opportunity tax credit. This is the final one I want to touch on. And again, as you guys are continuing to grow and hire individuals, this is a program that's probably our most popular program because this has been around since the 1980s. This tax credit used to be called welfare to work, and it used to only apply if you hired people that received welfare benefits. We all understand right now in this economic climate, we have a lot of people unemployed, whether that's by businesses shutting down or by personal choice. They're still receiving unemployment benefits. This program was encouraged to incentivize businesses to hire people from certain demographic groups that typically have a higher barrier to employment. This is a very personal thing to me. My father was a vet of Vietnam. He came, I remember him telling me stories where he would come home from Vietnam. He had a master's degree, went to Vietnam, came back to the United States, could not find a job with a master's degree for almost 4 years. Employers did not want to hire. Obviously, it was a different climate back then. These programs did not exist, but if they would have existed, I would think that he would have had a less of a barrier to employment than he had. So this program is very near and dear to my heart, and I see it happen every day. It lowers recidivism rates. It helps veterans get jobs. It helps single moms get jobs, people on food stamps, welfare, SSI recipient, people with disabilities. This credit is encouraging you to look at these targeted groups when you're looking at hiring. It is not discriminatory to look at these groups. In fact, the Department of Labor has come out with a survey and a study that said all things being equal, if you have a candidate that's the same from a qualifications perspective, they encourage you to hire these individuals from these targeted groups. We've also found out in an interesting study that people who come from these targeted groups typically have a 43% longer lifespan as an employee of a company than they do with people that aren't. That, you could call it whatever you want to. Maybe it's a sense of loyalty, maybe a sense of pride for a lot of these people that haven't had jobs or they're getting a job after having a major disability or things that have happened or coming out of prison or again coming back from the military. But we have seen those statistics. So this is a federal program and this is an income tax program. So for every individual that you hire that's from these targeted demographic groups, there's a potential $2,400 minimum, $9,600 maximum credit for these individuals. And all you have to do is hire them. The only caveat is this is a new hire credit. The government wants to incentivize you to hire them and not turn around and fire them immediately. So number one is you have to let the government know through organizations like ourselves within 28 days of hiring them that you've hired them. Once you do that, we make you eligible for the program and you can start receiving the tax credits based on the state that you're in, the state that you operate in. It's a federal program, but there are state offices set up to be able to process these things for you. They do have to work at least 120 hours. Please keep that in mind. The reason they put that up is when they first started the welfare to work program, they didn't have any of those caveats. You would literally have individuals hiring people from these targeted groups and turning around, keeping them on payroll for a week or two and turn around and terminating them. They're encouraging you to keep them employed at least for 120 hours to qualify. A couple of small case studies here. Blue collar, hourly wage, restaurants, these individuals can qualify for, especially right now when we have a 43% unemployment rate in this country. Doesn't matter if you're white collar or blue collar right now, there's a significant amount of people that are unemployed at this time. But In the blue collar hourly wage sector, you're going to qualify people a little bit higher rate. It's typically because of the demographics of the program. But here's a company that hired 50 people in a year. They got $115,000. Now let's take the math here. Let's imagine this company that was located in an empowerment zone that we just talked about also participated in the WOTC program, also participated in the COVID-19 program. Those numbers together that we've just looked at would add up to well over $1 million a year for a 50 employee company. That's $1 million in 100% cash back into the business that does not have to be paid back. It's not a loan. You don't have to give stock away, don't have to give equity, don't have to give royalties. These are programs that are built for businesses like yourself as you continue to grow. So let's talk a little bit about what WOTC does. Again, it reduces recidivism rates, like we talked about. It helps you hire individuals that are eager for employment in demographic groups that you wouldn't normally think about. And so highly encourage you guys to look at these programs. There's all kinds of programs you can work with in your local cities. Department of Rehabilitation Services. You can look at exiting programs for felons. It's amazing, guys. Most felons are not violent felons. We see this all the time. We see people who are on disability that continue to stay at companies for 10, 20, 30 years. And there are programs like DARS that you can go in, you can find, especially with companies that are struggling to find help right now and find employees. There are a pool of candidates out there that are available to you if you work with those government agencies and government organizations. And a lot of times cities and states even have their own programs such as this that they'll give you cash rewards for hiring individuals from these groups as well. So the key to this is every time you hire them, you've got to screen them the minute they come to work. You can't let that 28-day window go to waste. We want to make sure that those forms are in and submitted on your behalf. Again, we do this work for you, not asking you to do a lot of work. All we're asking you is to look at those groups and make sure that paperwork is submitted to us in a timely manner. So I'm going to talk a little bit about us real quick. I'm going to turn it over for questions. Guys, if you have questions, you can put them in the chat here. Happy to talk about anything that we covered today. Venture capital, angel investment, tax credits. We have Lindsay on the line who's going to read the questions out. If there are questions, feel free to go into the chat and ask those questions. Little bit more about us. This is all we do for a living. We work 100% on contingency fee basis for you. We do not charge you a dime until you get your tax credit. There is zero financial risk. We're taking all the risk here. Our goal is to look at businesses like yours that are continuing to grow, start at businesses and grow with you. The more you hire, the more credit you're going to get, the more we continue to grow. We put profit back into your business. We put cash back into your business. Been doing it 20 years. It is one of the most rewarding businesses I've ever been a part of. I get to look people in the face every single day and tell them that I've saved them money and I've helped their business grow. Great business to be in, very rewarding business to be in. So we're going to open up to questions. If there are questions, we'll give it a few minutes. While we're waiting on questions, I'm going to go ahead and see if Lindsay, if you're on the line here, if you have any questions.
I don't see any questions right now.
Okay, no worries. While we're waiting on questions, if there is any questions, Mike, do you want to kind of take back over here for us? And
sure. Yeah. Thank you so much, Shannon. I actually do have a real quick question. If you don't mind, just it was earlier in the presentation you talked about refundable versus non-refundable. Can you just clarify again one more time exactly what that means?
Yeah, absolutely. So a refundable credit is going to be a credit that you're going to receive a cash payment back from the IRS, and there are only a few programs which qualify. The COVID retention credit is a refundable program. The empowerment zones and the disaster credits are refundable credits, which means we're going to go back and help you file an amended return or amendment on your 941s, which are payroll tax forms, and get you cash payment from the IRS. Non-refundable is going to be the work opportunity tax credit, where at the end of the year, you're going to take whatever we save you. If you have a $100,000 check you have to write to the IRS and we find you $80,000 in credits, we're going to reduce that amount by $80,000 and you're only going to owe the IRS $20,000. It's not refundable, it's a reduction in your liability.
Got it. Thank you for clarifying. Appreciate that. Awesome. Yeah, if there are questions, Lindsay, just let us know. I just definitely want to say thank you so much, Shannon, and to your whole team. This was wonderful information, really, really helpful and valuable, I think, for the group here. I really appreciate it. Do you guys have what are some of the ways that folks can reach out to you? I don't know if that's where you were going next, but I thought I would just kind of pass it back to you to let folks know, if they're interested in working with you to see what they might qualify for and how they can save some money, what might be some next steps for them.
Well,
Hey, Shannon.
Yeah, go ahead.
We have one question. What does eTax Breaks need from clients to be able to know if they qualify or not?
So that question, it really depends on what type of credit we're looking for. Typically, what we're going to do is send out a questionnaire to a client. It's going to be anywhere between 8 and 10 questions. That will tell us, it's going to have location information, a little bit about what you've gone through with COVID, maybe a little bit of revenue information. Have you lost revenue? Did you have revenue during that time? Very simple questions, not a lot of information that we need to collect, and that will tell us if you qualify or not. That's something that Steve, and I have put Steve's contact information here on the screen for everybody. Steve can help lead everybody through that process. You have his contact information here on the screen. Steve, I don't know if you want to jump in and say anything as well here.
Sure, Shannon. Thank you for that. I am in Charlotte, and certainly if you would like to meet in person, even in this post-COVID world, or I guess in this still COVID world, happy to do that. Happy to get on a Zoom call with you. Also happy to just have a phone call, but I'm available and really look forward. As Shannon said, this is some of the most gratifying work that I've ever done in my career. Just helping small businesses really figure out ways to be more profitable. And I do a lot of work with startups. Mike and I have worked together for many years, and that's what really got me interested in this business was how can we make our small businesses and our technology-focused businesses more profitable early on in their career by ways other than selling new products. So that's why my interest is there, and I look forward to helping you in that way.
Awesome. Thank you. Yeah, I was just going to chime in there and say thank you, Steve. Yeah, it's I can see how the work is rewarding for sure based on everything you guys walked through today and shared. For some of the SBTDC clients that are on the line, I would definitely encourage you to take advantage. It's a very, very low risk situation. In fact, none, right, to reach out to them and see what you might qualify for. And please feel free to share with other business owners as well. Am I correct, Shannon, Steve, that you guys work with folks all around the country?
Yes,
that is correct.
Yep.
Yeah, that's awesome. That's awesome. And thank you for the work that you guys do. So if there's anything else that you guys have, feel free. I think just wanted to cap that and just encourage folks to reach out for sure.
I would say, much like the presentation today where we said we were going to take an hour of your time, we've only taken 45 minutes. That's the way that we like to work. We like to really over-deliver. It's not a hard lift from your perspective. We do the heavy lifting, unlike some of what you all possibly went through with PPP, and please call on us. And I will likely send out a survey as well as an outreach to you after this call, so be on the lookout for that as well.
Awesome. Anything else from Shannon or Lindsay?
I don't have anything except thanking everybody for their time, Mike, and thank you for the opportunity to speak. And please reach out to us if you have any questions.
Awesome. Thank you. Thank you guys so much. We really appreciate the information and the value that you provided today and for your time. And for all the folks that joined the call, please feel free to reach out to eTax Breaks to learn more. Like I mentioned at the top of the program, please feel free to reach out to us at the SBTDC. You can go to our website, sbtdc.org, and register for counseling if you haven't already, or if you're not sure who your counselor is. If you do know who your counselor is, you can just circle back with that person and let us know what it is that you're working on or what you need help with, and we can help you from there. So thanks again to everybody, and have a great rest of your Wednesday.
Mike, let me offer one other thing in closing, which
Sure.
is as a result of working with the SBTDC and wanting to invest in the businesses that the SBTDC is supporting, we are able to reduce the fees that we would charge for SBTDC clients. So that's another benefit in working with us.
Yeah, that's great. And I assume that's sort of like a reduction in the rate that you all would take in
Right.
actually helping find the savings, right, for the customer.
Right. Even more savings for the corporation that is a client of the SBTDC.
Wonderful. Thank you for that. Appreciate it. All right. Well, thanks again, everybody.
Have a great rest of the day.